Hello everyone, Scott Meyers here, and I wanted to make you aware of the upcoming Self-Storage Academy, which is coming to you live, backed by popular demand as the economy begins to open up again. The event will be held May 13th through the 15th at the luxurious Florida Hotel in sunny Orlando, and it's been totally revamped to give you the tools and resources to successfully find, evaluate, negotiate, finance, structure, and manage self-storage facilities in our new environment, which as we know has benefited our industry greatly. There has never been a better time to invest in self-storage, and my team and I have been preparing for the opportunities that the next recession would provide the seasoned and educated self-storage investors, and that time is now. And rest assured, we are prepared and want to ensure that you are as well. So to make 2021 the year that you launch and grow your self-storage business, we bundled our award-winning self-storage home study course, which has just been updated, and we packaged it with 2 tickets to the Orlando Academy, along with tickets to our virtual academy for those who can't make it or just aren't ready to go live at this time. And we're making all this available for only $997. That's $2,500 off the list price. So grab your seat before they're gone by going to selfstorageinvesting.com/Orlando to grab the bundle and to reserve your spot in Orlando. That's selfstorageinvesting.com/Orlando, and we'll see you there. This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Well, hello, everyone, and welcome back to the Self-Storage Podcast. I am your host, Scott Meyers, and this week's podcast is another in our Platform for Change series, and I'd like to introduce you to today's guest, Monick Halm. Monick is both an educator and advocate for women to create passive income streams through real estate investing, and her mission is to assist 1 million women in achieving their financial freedom through real estate. She is the founder of Real Estate Investor Goddesses and is an active real estate investor and syndicator with over 14 years of experience in multifamily, mobile homes, RV parks, commercial properties, vacation rentals, and ground-up development. Together with her husband and her investors, she owns over 1,300 rental units across 6 states. She is a #1 best-selling author of the Real Estate Investor Goddess Handbook and A Wealth for Women, and host of the Real Estate Investor Goddesses podcast. She is also a real estate mentor, speaker, recovering attorney, certified interior designer, feng shui expert, world traveler, and most importantly, a wife and mother of 3 amazing kiddos. So Monick, welcome to the show.
Thanks for having me, Scott.
Well, we're doing a round 2 here. Monick, if you would, I gave the folks a little bit of background on your long list of achievements and really what you're doing right now. So if you would, why don't you fill in the gaps and let us know what you're up to recently?
Yeah. So most recently, I've been focused on syndicating, bringing groups of investors together in the industrial space mostly. And I started out as house hacking and back in 2005, and I was just trying to be able to afford a house in Los Angeles. It's a very expensive market where I live, and went to small multifamily, single family, got into flipping after the crash of 2008, 2009 when houses were on sale, and then got into syndication, bringing groups of investors together in 2016. Yeah, and then through that process, somehow I found my way into doing more commercial stuff and industrial.
So you're in California. Are you investing currently in California, other parts of the country, or both?
Mostly outside of California, though we have a duplex here that we rent out. We also have um, an organic baby food like manufacturing facility that we got last
Now,
year.
that's a first for the podcast. Organic baby food manufacturing company located in an industrial
That's an
building.
industrial, yeah. So that's it. That's it for California, and
Yeah.
then everything else is we're in 10 states around the country.
Okay. 10 states now. Wow. Fantastic.
Hmm.
So industrial, again, self-storage is considered a form of industrial real estate. But when we speak about industrial, I think most people think about triple net leases and or manufacturing facilities like the one you just mentioned, and everything in between. Dollar General probably being the most common, at least I'm just speaking for myself. So if you would, why don't you touch on, a little bit about what you're doing in the industrial sector, and then, the types of assets that maybe you've been seeking in that sector as well.
Yeah. So I like the commercial sector, and I'm very very interested in self storage too. Though I haven't done that yet, but I did. As I had when I was starting in syndication. We were doing large multifamily, and I loved the idea of large multifamily, and we had a few of them. And in late 2018, we sold a couple of our they're definite C class buildings in Albuquerque, New Mexico, and we sold them at a 4 cap, which is just insane. It was great as a seller, very, very, very scary as the buyer. And I thought, okay, I I do not want to be competing against like people who are going to spend this much for these types of assets. And it just wasn't making sense. And definitely, it is very much of a seller's market. And I do not like being a buyer in a seller's market. So I started looking for something something else, something that wasn't quite so crazy, where the herds were not looking.
Mm-hmm.
And I started I fell into industrial,
Mm-hmm.
and there was this growing demand for that type of real estate, with as retail was suffering and
Mm-hmm.
online was growing. There's still, the online retailers still need warehouse space.
Mm-hmm.
They still need storage. They still need places for their distribution centers um, and there's data storage centers, and
Mm-hmm.
people still are doing research and development. People still are manufacturing things. People still are growing and processing food.
Mm-hmm.
And so there was this, I saw, oh, okay, there's this need for this type of house,
Mm-hmm.
this type of property, but there's not the feeding frenzy. So
Mm-hmm.
we got into it. We started we did a portfolio, 109 spots, 6 business parks in Houston,
Mm-hmm.
and then we started getting into something called a sale leaseback, which is when one company has a facility that they're using, that,
Mm-hmm.
and like our organic baby food company, they actually had that facility for a while. They had a fire and it had burned down, so they'd rebuilt it.
Mm-hmm.
And but they need to take the equity out. So often that's why they want to sell it, but they still want to use it. That's why it's called a sale leaseback. So they
Mm-hmm.
sell it, but then they lease it back. They become
Mm-hmm.
the tenant. And when they sell it, they're able to take the equity out. And the nice thing is, as a tenant, for the tenants in industrial, retail, office, they have triple net leases, and triple net
Mm-hmm.
leases are wonderful especially from a landlord's point of view, because the tenant pays rent and they pay all the property taxes, they pay all the insurance, they pay all the maintenance. So if there's a toilets malfunctioning, they will fix the toilets. If the floors, if
Mm-hmm.
the foundation has an issue, they'll fix the foundation. If the roofs have an issue, they fix the roofs. They do all of the maintenance. And so a landlord's point of view, it's very, very easy. And they're great, strong tenants. I think our in for our sale leasebacks, the youngest company we've done one with was 17 years old. I think as the oldest so far has been 82 years old. So
Wow.
they're just these, like, you know, like kind of running America in the background type of companies. They're not sexy, or not necessarily name, companies you'll know off the top of your head, but they're just these solid companies that have been going on for a long time, that are well capitalized, and they come in, they have a 20-year lease with built-in rent increase every year, goes up 2%.
Mm-hmm.
And so you know exactly what your income's going to be, you know exactly what your expenses are going to be, pretty much. And they're just these really nice deals. And then we exit in 4 to 6 years. We sell it to an institutional buyer, like a pension fund,
Mm-hmm.
or a insurance company, that kind of thing. And they the returns are very similar for our investors to a multifamily. So usually 8 to 10, 11% cash on cash returns, with annualized returns in the high teens to low 20s.
How many years does it take for you to typically achieve those returns or those IRRs, or I should say, how long are you looking to hold these projects?
Usually it's a 4 to 6 year hold.
Hmm. So how do you create the value? Typically when we're looking at self-storage, if it's an existing facility, it's 50, 60, 70% leased. The rents are below the market, and then we're adding ancillary income streams, similar to multifamily and others, by, selling locks, boxes, and moving supplies, adding technology, reducing payroll. Tell me what that looks like in a sale and leaseback. It seems like there's not as many levers to pull to be able to create the value to get the
Yeah.
returns that you need for your investors in 4 to 6 years. What's your superpower? How do you do it?
Yeah. The nice thing is you don't have to pull that many levers because the sale leaseback is the value add.
Mm,
So it is that's something that's not very common. Very, very, very few people do it. And putting that structure into place. So um, it's so uncommon, but once we have it in, so once they're in these now tenants,
mm-hmm,
they've gone from being the owner to the tenant. After 3 to 5 years, they're now a tenant with 3 to 5 years of steady payment history,
mm-hmm,
with 17 to 20 years left on the lease. That is something that these institutional buyers will buy all day, every day. They love those
mm-hmm,
types of deals. Um, but and so there'll be and plus we buy them for slightly below, as part of the leaseback, we buy them for slightly below market. So we have a built-in equity. We also rent them out for slightly below market. So the numbers still work with
mm-hmm,
that lower rent. If we lose those tenants, God forbid we lose the tenant. That's the biggest risk.
mm-hmm,
That doesn't end the game by any stretch of the imagination, but that's probably the worst thing that can happen in that situation, because it's not it's not like you have companies like a million companies that will take that need
mm-hmm,
100,000, 60 to 100,000 square feet of space. So you don't want to lose the tenant. So that's where our big due diligence piece goes through, and we have other things to mitigate that risk. But
mm-hmm,
um, we because of that, like once they're in there, that's a situation that these buyers are very happy to buy. So
mm-hmm.
that's how we can do we add value, but we don't have to. It's not a heavy lift though once they're
Mm-hmm.
in, which is the nice thing.
So in storage, we like to buy it by the gallon and sell it by the shot. So we like the 100,000 square foot buildings that we can, break up into 700 units and then lease it out, so that if we lose one tenant, we've lost 1/700th of our income versus, a single family house where you lose a tenant, you lost 100% of your income, or in an industrial building with one tenant,
Yep.
same thing. So obviously, the due diligence on your end has to be, exponentially higher than, I would guess, virtually any other asset class that you're looking at, especially something that's multi-tenant if you're trying to mitigate risk. And so, to your point,
Yeah.
clearly that's that's been your superpower. And also, to another one of your points, I'll take 100 industrial buildings with one tenant in it, that, as long if they're in the unsexy business of coffins and toilet bowls, and they've got a 80-year track record, then it doesn't need to be sexy to pay the bills, at the end of
Exactly.
the day.
But
So
yeah,
I have to.
it seems
Mhm,
like it's a big risk, right? Because especially if you're coming from, well, I have all this leverage because I have all of
mhm,
these different units. Or you lose
mhm,
one, and that's what I liked about multifamily versus single family. But it's the type of tenant, right? And so it's a
mhm,
tenant that is, like you were saying, has a long
mhm,
history. They're very well capitalized. They've got a lot of money in the bank. Over COVID, we had them also prepay like 9 to 10 months of rent.
mhm,
A
mhm,
lot of times they're personally guaranteed by the owner of the business.
mhm,
The lease is guaranteed. So we have a lot of things to mitigate
mhm,
that risk of having, but generally the big risk, and we're also getting their financials, so we see how they're
mhm,
doing, and we can help step in if things start to go awry. But we have, for the most part though, because of the how well capitalized these businesses are, and their long history, and their how well run they are, and
mhm.
that is the due diligence piece. It's not, they're very unlikely to go anywhere.
Right.
Yeah.
So I also have to ask, or at least think, when you're buying, you're on these 4 to 6 year cycles with your investors, and so in order to get those returns, yes, you made it clear the money's on the buy, and you've got some escalation clauses, and then having that history and that that sweet spot of 4 or 5, 6 years of history, then that's when the larger players, the hedge funds, will like to gobble that up because then they can see the solid returns.
Hmm.
Timing also factors into that.
Hmm.
So are you, we're typically on a 7 to 10 year cycle in terms of what the economy does, recession to inflationary periods. Do you do any of that timing in your modeling as far as your exit cap rate? And are you more active in those years and say this project is smaller and so we're going to exit in 3 years? And if you're 3 years away from, the economy being on an upswing and the interest rates are low like they are right now, and suppressed cap rates, do you do any of that timing in your modeling, and does that question make sense?
Yeah, it does make sense. So for the talk about the sale leasebacks and then our other our industrial. So with the sale leasebacks, so we're like I said, a lot of our companies, we have a lot of history that we're
Mm-hmm.
seeing, and we've seen them through different recessions, and especially the ones that we've bought over this past year and are buying now, they're performing wonderfully in this economy.
Mm-hmm. Mm-hmm.
So these are essential businesses. They're not going
Mm-hmm.
anywhere. So because of that, they're not as these particular companies are not really as affected
Mm-hmm.
by what's happening in the broader economy.
Mm-hmm.
So we're we don't necessarily think, okay, well, in 10 years or 5 years we're going to be we predict that we'll be here,
Mm-hmm.
because right, we're buying them now. Well,
Yeah.
it's just the ones are
Mm-hmm.
doing so.
Mm-hmm.
It's like it's probably not going to be worse. Who knows?
Mm-hmm.
But they're doing great now.
Mm-hmm.
So it's chances are that they'll be doing fine. In 5 years from now. But we do keep an eye on the financials
Mm-hmm.
just to make sure,
Mm-hmm.
and we will either not sell or sell sooner if it makes
Yeah.
sense.
Mm-hmm.
There was one deal that our partners had that it wasn't one of ours, but they had a series of they had some gyms that they had a gym chain, and they because it was harder with the gym, so they
Mm-hmm.
sold a little earlier, and
Mm-hmm.
in that deal they had projected 16 to 20% returns, and the
Mm-hmm.
investors are only getting 15%, but they
Yeah.
thought that which is like, I think most of the investors like we're okay with that.
Okay.
So
Yep.
it's just,
Mm-hmm.
but so they sold a little earlier and they went a little bit below where they had hoped to
Mm-hmm.
be,
Mm-hmm.
just to exit, because gyms were a little challenged during this particular period.
Yep.
So
For sure.
that can
For sure.
happen. With our other, so with the 109 units that we have with the business park, so a lot of those are retail, and
Mm-hmm.
um, using those that flex warehouse space.
Mm-hmm.
So with those, we do have modeling to that, this very extensive computer modeling to
Mm-hmm.
look at, looking at what's happening in the economy, and then just in general, you expect to have tenants come and go, and this
Mm-hmm.
is when their lease is up, and this is when a new one's gonna, and this is how long we predict being able to refill that, and
Mm-hmm.
so that modeling is built into that particular those deals. Yeah,
Mm-hmm. Perfect. Perfect.
yeah.
So tell me, your husband is involved in the business as well. What's his superpower and what's his role?
Yeah. So we have two businesses. So one is the real estate investor classes. That's our
Mm-hmm.
education
Mm-hmm.
business, teaching women, and then the other one is the investing side, being your
Mm-hmm.
investment partners. So and he's my partner in both of them.
Mm-hmm.
He's more back of the house, right? he's
Mm-hmm.
he's our COO, so he's doing the operations, and
Mm-hmm.
when it comes to deals, he's more on the due diligence side, and make sure that the I's are dotted, the T's are crossed, and all that stuff gets done. So, and he's in the back making he's doing the deals and
Mm-hmm.
working on that side of it.
Perfect. Well, it sounds like a
Yeah,
good partnership.
it is. Yeah.
So if you would, let's talk about the marketing piece to this. How do you, or do you go out and actively seek, buy a list of industrial building owners and reach out to them with a fantastic letter that shows them about this untapped equity and what they can do in a sale leaseback? Are they coming to you? Is there a combination of? Tell me what the marketing looks like, and how do you fill your funnel of opportunities?
Yeah, they are coming to us, or brokers are bringing us deals.
Mm,
So many that we haven't had to go out and market it. So
mm-hmm,
they've come to us, which is nice. And we'll say no to a lot more deals than
mm-hmm,
we choose to do. Mostly it's because we're not confident enough about the company.
mm-hmm.
Then we'll say no.
Mhm.
So probably 80-90% we're gonna not do.
So in a sale leaseback, then are you going out and securing debt leverage on your own and then syndicating for the equity on top of that? Or on some of these sale leasebacks, are the owners willing to finance and be the bank for you, and then you lay your private equity on top of that? Or what do most of your projects look like?
We are having lenders. Yeah. So with the sale leaseback, it's not really going to work because they're selling because they want the cash out.
Mm-hmm.
They want the equity. So we get lenders that will finance usually like 70-75%,
Mm-hmm.
and then we'll get private equity for the balance.
So in 2016, you got into syndication and raising
Hmm.
private equity. Was
Hmm.
that because of the growth? And I mean, when you jump into commercial, I mean, your bank account gets drained pretty quick, maybe on your first deal, and then you have to learn how to syndicate
Yeah.
or start a fund in order to grow. Was that the case in your end, or what brought you to the place where you decided to start a syndication company?
Syndicating. Well,
Mm-hmm.
it's funny. It was 2015 when I first found out about syndication.
Mm-hmm.
I had to that point had been mostly we'd been flipping houses in Los
Mm-hmm.
Angeles, and we started when houses were on sale after the crash. They were not so on sale in 2015,
Mm-hmm.
and it was getting very competitive, and I was getting frustrated by the flipping, and I thought, okay, I want to buy and hold. I don't want to,
Mm-hmm.
be doing all this active work and then you
Mm-hmm.
sell and just start over again. It's like a job. And I started looking for a fourplex, which is,
Mm-hmm.
what I knew. And nothing in Los Angeles makes any financial sense for that. It's like nothing cash flowed.
Mm-hmm.
It'd be over $2 million and there'd be no money in it.
Mm-hmm.
So I was really frustrated. A friend of mine said, "Hey, it's like his friend, Robert Helms, who's the host of the Real Estate Guys Radio podcast. He's like, he's coming to LA tomorrow night. You want to come to dinner and talk to him? Maybe he
Mhm,
can help you." And so he's like, "Yeah, he's done like hundreds of millions of dollars worth of real estate investing, and he might know a thing or two." So I was like,
mhm,
"Okay, yeah, that can't hurt." So I went to dinner. I remember it's October 15th, 2015. And so we were chatting before dinner, and Robert's like, "So what are you up to?" I told him about the flipping and then trying to find this fourplex. And first thing he told me was, he says, "LA is a tough market. I always say live where you want to live, invest where the numbers make
mhm,
sense."
yep,
And I went, "Oh."
mhm,
You're nodding like, of course, yes, right? But until he said that, I hadn't thought of that.
mhm,
I'd always assumed that you had to buy where you lived, where
mhm,
you could drive to your property, touch it, self-manage it. Like it didn't occur to me that I didn't have to invest where I lived. So I was
mhm,
like, oh, or is it literally that opened up the world to me? Because LA is so expensive. It's just
mhm,
a lot of investing here doesn't make sense. And then he said, and you can buy that fourplex by yourself, but you're limited to your own capital and credit. He said, alternatively, you can bring a group of investors together and instead you could buy a 100 or 200 unit apartment building. And he started telling me about the benefits of that.
mhm, yeah,
My
mhm,
brain exploded. I was like, what? Like I honestly thought you had to be a billionaire to do that.
mhm,
I did not realize that normal people could do that sort of thing. But everything in me, and when I was always already a bit tricky for us to get financing because we were self-employed, and if you're
mhm,
not a W-2, it's It's super tricky, and I was like, wow. Like, so I was like, oh yeah, that I want to do
Mhm.
that. So
Mhm.
I went home. I told my husband, like, there's this thing. It's called syndication, and let's learn how to do that. So that's how we found out about it and what got us excited. And I love that we could do bigger, but also help other people while along the way. And it's just very win-win. And
Mhm.
I was like, I just got super excited by the whole concept of it. And I was and I was really, really happy to be around people who thought that 100 or 200 units or these big projects, that was normal,
Mhm.
until that moment of everyone in my world thought a fourplex was such a big deal.
Mhm.
And so I was like, yes, that, I want to do
Mhm.
that.
Mhm.
So that's how we got into it. And we just hit the ground running. So in 2016, we got over 1,000 units, doors through syndication, and then just have been going since.
Yeah, fantastic, fantastic. Well, I wanted to also touch on the education side of your business. So, real estate investor goddesses. I read the bio on your company, and I'm an educator as well. And some of the pieces that you touched on, I can clearly tell that you're used to educating people. And one of the things that I noticed is that folks from California, we hear this over and over again. They've even said themselves, they repeated your words, perhaps that came from you, is that yeah, you live where you want to live, but you have to invest. They say we have to invest somewhere else because it just doesn't work in California, and so we always know what's coming. But tell us how you're approaching your students that come to you. How are you assisting them, in what capacity, and what does that look like for folks that are looking to, well, folks, I don't know if you allow men or not, but for the women that come to learn how to invest with you, what is it that you're specifically teaching? Is it the industrial side, commercial side, or all facets? Give us a little insight into that.
Yeah. So I am asset class agnostic. So what they're
Mm-hmm.
learning when they come is these foundational principles of real estate investing, how to do it as a woman from the feminine, because women, we're not just smaller, less hairy men. We're actually really chromosomally different, and our our brain chemistry is different, and those differences do affect how we approach money and investing and learning and
Mm-hmm.
stress, and
Mm-hmm.
and what works best for us. So it's how do you do this from the feminine, and then, because I do not believe real estate investing is one size fits all, the program is really designed to help them figure out what is the path for them. So in our program, we have women that are successfully creating passive income streams through real estate investing, but some are doing it through notes, self storage,
Mm-hmm.
industrial syndication. Some are passively investing, some are actively investing, some wholesaling. They're doing a bunch of different things, and but it's guided through their this process we take them through to figure out their path.
Mm-hmm. Mm-hmm.
Yeah.
Very good. Very good. Well, Monique, if you would, before we wrap up here, tell us a little bit about, what has changed, if anything, in terms of your approach to the market in 2021. Are you leaning more towards industrial, mobile home parks? I mean, as you mentioned, you're asset class agnostic, so you're looking at everything across the landscape. Where have you seen some of the opportunities, and where are you focusing or doubling down on?
Yeah, so our focus is still on industrial this year,
Mm-hmm.
though we are working as well on putting together a non-performing notes fund. So we
Mm-hmm.
have a partner, and so we've done some investing too in non-performing notes, and that there's a lot. We're seeing a lot coming down the pike
Mm-hmm.
for the
Mm-hmm.
people who haven't been paying their mortgage, aren't able to, and so
Mm-hmm.
there's a lot of opportunity there. And but yeah, mostly that has been, we're more in the industrial side, or staying away from residential
Mm-hmm.
currently.
Mm-hmm.
um and but otherwise, I'm keeping nimble, keeping money
Mm-hmm.
on the sidelines, because I think that as opportunities come by, they're it's it's been a very interesting market. It's been a very, because
Mm-hmm.
with all the printing of money from the federal government, all the all this, the trillions that were put into the system, I had expected that we'd have much bigger dips in the residential space already. But
Hmm.
as the cap rates continue to compress, I think we will have I think we will have a correction, or we'll have a,
Hmm.
a loosening.
Yeah.
I don't think it'll be as bad as it was in 2008, 9,
Agreed. But
um,
coming.
but coming.
Hmm.
So I'm kind of waiting on for when the prices make more sense to
Hmm.
invest on those fronts.
Hmm. Great.
Yeah.
Well, I believe that being opportunistic is the best way to approach the sell market right now, and especially when you've got a lot of arrows in your quiver, you can begin to pivot, and you know how to identify opportunities in the marketplace and the various asset classes when you see them. So, good for you. Good position to be in. Well, Monique, once again, thank you so much for your time today. I appreciate it. We learned a little more. I believe the audience did about the industrial side, as we haven't really done a deep dive in that area. And then appreciate your approach to that market as well as in general. So I can see why people gravitate towards you. So if you would share with the folks the ways that they can find you on the socials or our website, how do people get in touch with you if they want to learn more about what you are doing or get in touch with you?
Yeah, the best place to go is probably our website, reigoddesses.com. So REI for like real estate investor, goddesses.com. And we're also at REI Goddesses on most of the socials.
Fantastic. Well, Monique, once again, it was a pleasure. I thank you so much for your time, and I hope to have you back sometime in the future.
Sounds good. Thanks, Scott.
All right. Take care, Monique. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.